Let's get our next guest, the management of Subex Limited, Surjeet Singh, CEO and Managing Director. Subex is a name which since Q4 numbers has done particularly well, and in the last 6 months, it's almost up about 47%. Sir, thank you so much for joining us this morning. You know, there have been a lot of issues in the last 6-7 years as far as Subex is concerned, especially relating to FCCBs, how essentially they would get converted, how would the debt equity ratio look ahead. And I believe that 90-95% of the issues are now behind after the Q4 numbers. Can you just take us through this journey and what are the debt equity or ratios looking at this point of time?
Sure. I think you're absolutely right. The Subex name was largely associated over the last 5-6 years with a lot of balance sheet issues, primarily on FCCB debt and also large working capital debt, etc. And I think the management team focused over the last 3 years was parallel in the sense that it was important to make sure that the operations were profitable and growing, which is what I think the company has been able to do, wherein by the new order intake, as an example, grew almost 20% last year. Our profitability was improved from almost 6-7% to now almost 23%. And parallel to that, I think there was an effort based on this operating confidence to provide on one side to regulators, on the other side to the debt holders, to basically have them convert the debt into equity. And that's where I think the board played an important role along with the management to make sure that all the stakeholders got sort of adequately covered. I think you ought to recognize that Subex is a very sort of unique situation, capital structure-wise and shareholding-wise, one of the fewer companies which is widely held without any promoter, etc. So what we've been able to do here is to manage both an operational sort of restructuring and revival and parallelly the capital structure sort of reconstruction now, where I think we are almost debt-free fully, because whatever little debt is left, I think we have equivalent or more cash on the balance sheet around it. So something which was sort of written off 3-4 years ago as something unrecoverable is today probably a healthy company which is focused now on sort of finding itself on its own feet based on the customer and the market strengths that we have.
Right. So, as you're saying that FCCB issues are now behind, we have converted FCCBs, a lot of FCCBs into equity. What sort of dilution has it led to on a percentage basis? And going ahead, will there be more dilution, or as of now, we are quite comfortable?
No, I think we are quite comfortable, and the equity base is obviously large. It had to be, given that the company had almost $90 million worth of debt, and the market cap was sub $30 million, etc. But I think that is lesser of an issue now, given that A, the equitization has happened, B, the operating performance is now on a standalone basis, company-wide is profitable. The company is throwing a lot of cash every quarter. We don't have the interest burden that was putting the stress on the balance sheet, and therefore inability to put investments into play. So all in all, I think this has been a journey where something that was fledgling and was questionable relevant to its survival is now not only looking up but also growing.
Right. Can you just tell us what does the company do in the last? What did the company do in the last 3-4 years in terms of business change? What are we looking at in terms of growth going ahead? As you said about the order inflows that we are talking about, there are a lot of geographies where you have expanded which you were not there earlier.
Yeah, I think it was important to do 3 things operationally, right? So one was to right size the company's cost structure, which is easy to do in my view. But yes, but what was more important was to align the business model of the company, which was historically purely license based, into where the market is moving, which is largely service orientation. So what we did was that we actually moved our business model to from a pure play license and support to what we call as intellectual property based managed service, and now almost 50% of our revenues actually come from that subsegment. That's point number one. Point number two, I think we focused very heavily to make sure that our revenue recognition was more a lag indicator, and I think the lead indicator was the new order intakes. And we try to bundle multiple services to make sure that we are able to take multi-year contracts to have higher visibility. And the result of that now is that, even as we do $55 million in revenue every year, I think our order book is almost 3 times that at any given point of time. And then for any intellectual property based business, it's extremely important to have that level of visibility to not only cover fixed cost, but also invest in its future. And third basic thing that we did was that our R&D effort or the intellectual property effort actually focused more to do co-creation with our customers and actually make the company more outside in rather than inside out. So I think combination of those things led to the company not only growing within the constraints of the market it operates in, but also growing profitably. So that's one part. And the second part is that we found ourselves to be in adjacent areas. We serve the CFOs of telcos very well because we manage their revenue operations exceedingly well. We have now branched out to actually start managing the capex deployment for the CFO's office so that we can be a partner of choice in managing the entire return on capital employed, which the CFO manages overall. And then we have slowly started to invest ourselves into the space of insights and analytics, which I know a lot of companies are trying to do and is largely talked about. But we are trying to take a unique position to focus more on how insights are consumed in our customer environments and actually therefore create a consumption-based latent demand and deliver that on a portfolio basis through our bureau offering rather than pure play services or body-based or reports and formats. So what we're trying to do is we're trying to stay close to our core, but at the same time expand meaningfully along with our customers, co-creating with them and making the business model move more on a managed services basis than on pure technology basis.
Right. I was just looking at the Q4 numbers and probably trying to come out with a trend on the Q3, Q4 numbers. One of the big change has been marketing as well as allied services charges. So there we have seen an expense increase, but overall we have seen the margins going up. That's what you meant in terms of cost rationalization. Are you also looking at marketing activity to increase the brand awareness?
Yeah, that's correct. So I think now that for a lack of a better word, everything that was negative about Subex is done, and we were, always sort of looked upon or frowned upon as a company which will have so much of debt, and therefore this negativity is over. I think we are trying to position ourselves back into the thought leadership and innovation sort of category where truly the legacy of Subex lied 10, 12 years ago when it was probably one of the first intellectual property based players out of the technology segment. I think brands are built more by demonstrating value to customers than by claiming them in the marketing agencies. And what we're trying to do is to basically go back and rebuild our core and stay core to our strengths and actually expand into related areas. We still have limitations in where the company can invest. Obviously, we still have to make choices. While the capital structure is clean, we still have a smaller sort of footprint, if you will, relevant to our portfolio. So we're trying to be cautious. We're trying to be cautiously optimistic. We're trying to pick our battles, but we're trying to go deep and hard into what we pick and decide rather than spray and pray and stay very spread thin, so to speak.
Right. Sir, thank you so much for explaining us that what has changed in Subex. Of course, this is a name which has done very well. It's up about 47% in the last 6 months. We're taking a break, coming back in 2 minutes.